Test. Welcome back. My name is Aria, and I don't waste your time, so let's get straight into it. We spend the majority of our time as investors looking at whether or not a company is a buy. Is this company currently undervalued? Should I wait a little bit longer and buy at a lower price? Should I avoid this company altogether? Is there a better alternative in the market that could possibly yield me a higher return? I'm potentially looking at buying Meta. Should I be buying Google instead? Maybe I avoid Google altogether and I go for another big tech name. I buy Amazon. The majority of our time as investors is focused on whether or not we should buy a company. Very rarely do we talk about potential exit strategies. I've bought this company, it has appreciated significantly. Should I potentially look at trimming this business or selling it altogether? Is this a business that is going to be an opportunity cost for me over the next year, 2 years, 3 years, half a decade? And frankly, the reason for that is because it's a very difficult topic to tackle. At the end of the day, there is no right answer. Should you sell a stock if it goes up X%? After you make a double, should you be selling that business? Well, no, in many cases, that has nothing to do whether or not a stock is expensive or not. Oh, well, then you should sell a stock if it hits a 30 PE. And again, in that case, there's a lot of examples where if a stock actually hits a 30 PE, because it generally trades at 50 times earnings and it trades at a premium to that valuation, it's probably a good time to be buying that business. Case in point with something like Fair Isaac. Well, then if a company trades at a cheap valuation and goes to an expensive valuation, then you should be selling out of that business. And again, there's examples historically where, for example, Apple stock, when it went from a 12 PE to a 24 times earnings multiple, you would have been completely wrong to be selling that business, because not only did it continue appreciating in terms of earnings multiple beyond that point, but also they continued selling more and more iPhones and continued executing and growing their earnings, and the stock continued appreciating beyond that point as well. And so, ladies and gentlemen, in today's video, we're going to be tackling the difficult topic of whether or not you should be selling a business. And part 2 to that equation, if I were to sell ASML today, and not sell, but potentially trim about 1/3 of the ASML position, what stocks should I be looking at potentially reallocating that capital towards? And by the way, if you'd like to see my portfolio and see my moves before I end up making a YouTube video to update you guys, you could do so completely for free as long as you have a valid email address. You can see the live version of the portfolio over on Blossom. The link for that is in the description down below. Again, as long as you have a valid email address, which I hope you do, you could do so completely for free over on Blossom. And so with that being said, in terms of why I'm even considering trimming a little bit of ASML, I'm sitting on roughly 100% in terms of gains. If the stock were to go to 1400, I would have 100% gains on the total position. This is a company that I've pounded the table in terms of buying for months and months. I've done countless videos saying just how undervalued this company has been. I've owned the business since September of 2023, but of course I added heavily to it as it continued to kind of pull down in late 2024 and early 2025. And right now it's approaching roughly $40,000 in my portfolio. And so I'm roughly considering selling maybe about 6 shares or so. And the reason for that, which again, I've outlined time and time again, is it's starting to kind of trade a little bit rich in terms of where ASML generally trades at historically. If we take a look in 2021, it kind of peaked out in that roughly 55 to maybe 60 times earnings multiple. Later in the summer of 2024 and spring of 2024, again, it kind of peaked out at about 55 times to maybe 60 times earnings. And so right now we're not there yet. We're at roughly 49 times earnings. But if the company were to go up to 1,550, it would be trading at 55 times trailing earnings. And again, there's tweets of me talking about this. I'm sure I've mentioned it at some point in a video somewhere, but I've maintained time and time again that I would consider trimming a little bit of my ASML position if it were to get to those rich valuations. Now, with that being said, we do have earnings that are right around the corner. It's in about 5 days. It's Wednesday of next week. And so that does kind of complicate things because, of course, if they blow the earnings out of the water, then it becomes all of a sudden a little bit cheaper on a trailing basis. So I'm probably going to wait to maybe trim this position after earnings. And frankly, it's not even at a 55 PE right now. So there's that also. But by extension to that, in terms of what I'm considering reallocating the capital towards, if I were to trim ASML, I've kind of boiled the list down to roughly 7 different ideas. The first of which would be to literally just keep it cash. And that would be roughly a 10-ish% cash position. And I would kind of look at over the next handful of months, if there's an opportunity. Shopify has been on the watch list for a very, very long time. I'd maybe look at potentially buying that at a cheaper valuation. We'll come back to that in a second here. But again, kind of keep it cash, weigh my opportunities, and potentially look at buying something later down the line. The number one candidate, though, which I think actually would be high grading the portfolio, is adding to FICO. FICO, if you didn't know, I actually did buy kind of the same months that I added significantly to my ASML position. And the stock in terms of valuation is actually cheaper than when I initially bought in August of last year. So if we take a look during the sort of Pult attack months or whatever you want to call it, with the Pultz guy on Twitter was talking about the FHFA chair when he was kind of talking about regulating FICO and this and that, which by the way, can't really happen. But anyways, this is a topic for another video. I initiated my FICO position at roughly a 39, 38 times earnings multiple. And if we take a look today, it is trading at roughly 38 times forward PE. Now, admittedly, this is non-GAAP, so it's a little bit more rich on a GAAP basis. But even if we were to kind of compare this on a EV to EBIT basis, you would basically see the same thing. And in my eyes, personally, I think I would be high grading the portfolio because no matter how you spin it, ASML at the end of the day is generating the majority of their revenues from the DUV machines, which they do have some competition on that front. Broadly speaking, they have a 90% market share in lithography systems across the board. They are a monopoly in the EUV machine. They're the only company that is able to make the EUV machines, which is the new generation of lithography. And so it is a very fundamentally strong business. But then you have FICO, which has a 98% market share in securitization, which is essentially when these mortgages are packaged together as a mortgage-backed security and sold on the secondary market to investors. They have a 98% market share, and it's essentially a stamp of approval, a sort of means of communication between investors that, yes, these 1,000 mortgages that you're buying as a yield vehicle, they are in fact a subprime group of mortgages that you're buying, or they're a prime group of mortgages that you're buying, whatever the case is. It's a means of communication internationally speaking. And so basically the appeal with potentially selling some of the ASML and reallocating it to FICO, which by the way, funny enough, they report on the same day. They both report on the 28th. So there is a world where ASML pops on earnings. Hopefully the earnings aren't too good, but it pops on earnings, and then FICO on good earnings drops on that day. And then so I could kind of make that swap in the event that that's going to happen. But basically the appeal with this swap is that FICO essentially is, in my opinion, a slightly wider moat business. When we did the video of me ranking the moats of these companies, I put them on the same tier. I would, roughly say that they have similar quality moats. At the end of the day, it doesn't matter too much that this one's a 98% market share, super wide moat company, the other one's 98%, whatever the case is. They are roughly equal in terms of moat in my eyes, but nonetheless, it has a slightly wider moat in my personal opinion. Then at the same time, at that point, it would be a cheaper valuation. And if we take a look at FICO, I think they're going to be growing revenues close to 20%. You do a little bit of buybacks, a little bit of margin expansion on top of that. All of a sudden, you're looking at comfortably north of 20% in terms of earnings per share growth or free cash flow per share growth, whatever you want to look at it. All the while, I think ASML probably, with everything we know now with their 2030 guidance, when you work the numbers back, they're coming close to a high teens EPS growth rate. So I'm essentially, if I were to trim a little bit of ASML to buy a little bit of FICO at a cheaper valuation for a slightly better moat, I'm getting more growth. That's kind of the main appeal with that. And at the same time, I would be kind of building up that FICO position. It would be roughly a 17% position. And so my portfolio would kind of look something like this, where basically between the positions of FICO, ASML, Uber, and Adobe, they're all roughly sized similarly. And again, FICO is a business that I've generally wanted to add to. And right now, again, it's at the same valuations that I was buying at in August of last year. So it'd be quite undervalued at that point. So that's option number one as a candidate of me trimming a little bit of ASML. I think that's probably one of the most compelling ads. The second opportunity I'm kind of looking at is trimming the ASML. And at the end of the day, in terms of the most undervalued opportunities in my investable universe, Adobe and Uber kind of stick out as two of the most undervalued companies. Meta is also there, but I've kind of ruled that investment out at the moment. I probably need to do a little bit more due diligence, and I'm not sure how I feel about Zuckerberg at the helm and all that great stuff. I do really like that company as well, but within my circle of competence that I've done hundreds of hours of research, Adobe and Uber are still some of the most undervalued companies that I feel really strongly about. And so I could kind of split it 50-50 or allocate all 6% to one of those companies, and that is something I'm thinking about, but I'm not so sold on at the moment. I'd be definitely downgrading the portfolio in terms of quality, all in the name of getting a better PEG ratio. I've also kind of floated the idea of maybe adding all 9% of the extra cash into just Uber or something like that, right? Again, I do think that Uber and Adobe probably have higher future return potential than something like ASML today. But my mental block on that is that I would be kind of sacrificing quite a bit of quality, because again, if we refer back to my tier list that I did, I kind of rank, I would say Adobe is definitely a wide moat business. Uber is kind of a younger company, and that's why I kind of put it in the strong moat category, but I do think they are on the path towards being a wide moat business and kind of proving their moat and whatnot. But again, I mean, if we look at it on a PEG ratio basis, both Uber and Adobe are significantly undervalued at the moment. And then I'm starting to lose count here, but I think we are on our fourth sort of different possibility. I've just made a video on them. ServiceNow is a very, very wide moat business in terms of SaaS. Again, I just did a video on them. This is as good as it gets. With this company, you have a 98% retention rate software, very strong, durable revenue growth. The company is super, super high quality, very, very wide moat in my personal opinion. The growth is quite strong. The valuation is a bit of a weird one. It's trading at 10 times sales for roughly 20% revenue growth rate. What I've recently started to do, which I used to call this sort of maturity state margins, is how I kind of wanted to go about it. This guy on Twitter, and I think he has a YouTube channel as well, but He calls it look through earnings, which essentially means like, a company that is kind of ramping margins or isn't profitable yet. Yeah, you could value it on sales, but also if we wanted to kind of translate that into what maturity state sort of PE multiple would kind of look like, essentially what you do is you just take the current revenues that they have and like apply a quote unquote 25% maturity state margin, which I think ServiceNow at maturity would be able to achieve those type of margins. I think Salesforce today has like a 22% net margin, right? So if anything, we're kind of undershooting what their maturity state margins look like, but this is essentially sort of like look through earnings. And basically what you do with this is you look at that roughly 40 times earnings multiple, right? Look through earnings multiple, and then you just take revenue growth as a proxy of EPS growth. So the question you need to ask yourself as an investor is, would you be willing to pay 40 times earnings to buy about 20% earnings per share growth rate in a name like ServiceNow? A lot of people, I would imagine, say yes to that because it's a very, very durable, predictable, free cash flow machine of a business that is able to consistently generate that level of growth with a high degree of predictability. For me personally, when I'm looking at other opportunities, I think FICO, again, on a moat-wise, definitely beats that. In terms of growth, again, definitely beats that, right? So when I look across the board, I would still be more inclined to add to my FICO position as opposed to buy ServiceNow. They're roughly trading at the same valuation, but FICO is a wider moat with better growth. And so that's why I'm kind of ruling out this investment. If I wanted to buy a software name, then I would be considering something like Adobe, which I definitely understand a lot more than something like ServiceNow, which I've never came into contact with. Very, very B2B enterprise heavy sort of software. And frankly, I haven't done as much research, but nonetheless, this is an opportunity that I've kind of entertained. The fifth company in my investable universe that I have also talked about potentially, if I were to trim ASML, I would be inclined to maybe looking at is General Electric. This business model is eerily similar to that of ASML, but perhaps to even a further degree. I did do a deep dive on Safran. Safran, very similar business to GE. It's one of their sort of frenemy, sort of competitors, but also a partner with them. They have like a joint venture together called CFM International. That'll be up on screen. It'll be in the corner. I'll include it at the end of the video as well if you want to watch the deep dive that we did on Safran. But the gist of the GE business is that they make jet engines, and they're one of only few companies that make jet engines. They essentially sell you these things at almost no profit. So that is a slight nuance, whereas ASML sells you the lithography machines at a massive profit. Majority of their revenues and profits comes from, maybe not profits, but majority of their revenues comes from selling you the machines. In the case of GE, they actually sell you these jet engines at a gross margin loss. Like they literally do not, on a unit economics basis, they do not make they do not make profits on selling you those jet engines. And instead, what they're banking on is once these jet engines go into a plane and that plane gets sold to a Delta Airlines or American Airlines, whatever the case is, those companies need to get servicing and maintenance and upgrades done on those jet engines throughout the lifetime of that company. Throughout the lifetime of that airplane operating and doing flights, right? Typically, roughly every 7 years or so, they need to come in for a major overhaul. And in the case of GE, they make massive, massive servicing revenues on those jet engines once they've been sold and once they're, out there and operating and whatnot. I believe, just off the top of my head, I think about 70% of revenues comes from servicing and maintenance and upgrades and stuff like that, right? And the great thing that they've kind of done with that, they've switched that from a charging you every time you come in for an upgrade or maintenance or whatever the case is. They've changed the business model from charging you per shop visit, that's what they call it, to MRO, which is essentially kind of like a subscription business where the airline, you pay a flat rate to GE, I believe like per quarter or per year, whatever the case is. And it's sort of like a subscription where, anytime this jet engine breaks down, we bring it into the shop and you guys fix it. It is less revenues to GE, but is way more predictable in terms of cash flows as opposed to these airlines that could potentially, delay by a year or whatever the case is. And so it's a very, very strong candidate. It is trading at a discount, but it does lack in terms of growth a little bit. I estimate that the company could probably grow earnings per share at roughly 15% or so. And so you contrast that with something like ASML, which probably should be achieving at least about 17% or thereabouts. So if I were to sell ASML, I'd be buying, I would say, equal moat in my personal opinion for a little bit less growth at a cheaper valuation. It's not that appealing. I think GE would probably have to go into the low 200s, roughly 200, maybe 220 for me to kind of seriously consider that opportunity. And even then, you have FICO over here trading at 1.5 times PEG. That is still, in my personal opinion, way more appealing of an opportunity as it stands currently. And so I have one more bad sort of option that is still on the table. And then the seventh option, I would say, is probably second most appealing among all the opportunities that I have outlined so far. Zeta is the sixth opportunity. I immediately kind of ruled this out because the difference in terms of what I'm doing here, Zeta is very much supposed to be a sort of more speculative growth bet, albeit the valuation is quite cheap, right? Like 4 times sales, roughly, 20 times look through earnings. Again, shout out Jake. It is a phenomenal opportunity. I think the business is going to perform really well. But Zeta, at the end of the day, is a very much younger business in terms of its growth curve, the moat, all that great stuff. And I don't know, just to speak plainly, it just feels wrong to kind of sell that quality of a business to reallocate to a Zeta. I would rather just kind of inject cash, incremental cash that is coming into the portfolio into Zeta, as opposed to sell that business to put it into Zeta, right? Like, if that makes sense. I think you guys understand what I'm saying. The seventh opportunity, though, which I would place this as second most likely, and I've been going to war on Twitter. If you guys follow me on Twitter, you would know what I'm talking about, but I've been going to war with people over stuff like this. Ladies and gentlemen, Netflix. Netflix is such a phenomenal wide moat business. I think out of every single company I outlined, maybe not GE and FICO, but out of all the other opportunities, I think Netflix probably has the widest moat. Maybe it's roughly on par with, say, an Adobe. I do think Uber has probably a narrower moat. This company today trades at a forward PE of, I want to say 27 times. Yeah, 27 times forward PE for what I estimate is at a bare minimum, 20% plus earnings per share growth rate out into, call it, the next 5 years or so. And I personally think this valuation is actually overstating the PE multiple or the price to free cash flow multiple that the company is probably actually trading at because, of course, that acquisition with Warner Brothers. I talked about this in the dedicated video that I did about the Warner Brothers acquisition, but in my personal opinion, and you can call me crazy, you can call me, oh, you're being too hyper bullish, this and that, whatever. I think that is a genius acquisition. I personally pegged the number at within year one of that acquisition closing, they could probably come close to generating an incremental $10 billion of free cash flow. The business of Netflix today doesn't even generate $10 billion of free cash flow. It generates 9.5, I want to say. Yeah, right on the dot, $9.5 billion of free cash flow, right? So, and by the way, the breakdown with that is I'm saying you get roughly $5 to $6 billion of incremental free cash flow from the cross-selling of the Netflix brand and the HBO Max subscription. In order for that to happen, you would roughly need an incremental 50 million people to subscribe to HBO Max, which I'm not so sure, are they going to bundle it? Are they going to sort of like cross-sell it? Will they give you a discount if you're already an existing Netflix subscriber and want to subscribe to HBO Max? Will they do it like how Disney does it, where, there's like a Hulu tab under the Disney Plus website or under the Disney Plus app, whatever the case is, right? So there's a variety of different ways that they could kind of go about this. The point is they're going to bundle it in some capacity. And in my personal opinion, I don't think it's that far-fetched that we see an additional 50 million subscribers subscribe to the HBO Max brand. Netflix just came out and said they have 325 million subscribers. Even if we assume every single HBO Max subscriber also has a Netflix subscription, which isn't the case, but let's just assume that, it's not far-fetched to believe that 1 in 4 Netflix subscribers also subscribe to HBO Max when it becomes discounted and when they show you, hey, you know what, we have Harry Potter and Game of Thrones that you can watch now, and we also have Superman and the DC universe and this and that and whatever. We have all this incredible IP that we are now opening up to you, the Netflix subscriber, at a discounted price. You don't have to pay $20. You can now pay $10, 50% discount, right? And then that also leaves room for in the future that they remove that discount. Once you get onto the HBO Max subscription and you start watching Game of Thrones and you get invested in some of these different spinoffs, what if 2-3 years down the line, whatever the case is, right? Like, hey, that 50% discount we've been giving you all along? Yeah, you know what? We've decided to remove it. And so odds are like a huge amount of people stick around because they are now invested in these shows that they previously would not have subscribed to simply because of the distribution of Netflix. Not to mention, with the financial power of Netflix, with the financial backing of Netflix, you will have a whole slate of new content being generated with this new IP that they are buying. So super genius acquisition. I personally, again, you call me crazy, but I personally believe that barring any massive investment into the IP, which you'll probably get, some investment within their first year of owning this, but basically on day one, you could probably start to monetize the HBO Max subscription and the HBO Max IP that they're buying from Warner Brothers. And within year one, you could probably come close to about $20 billion of free cash flow, which kind of works out to $5 to $6 billion of free cash flow from, people subscribing to HBO Max that they previously wouldn't have. There's about $2 to $3 billion of synergies that you recognize. And then, of course, the business in of itself is generating at least $1 to $2 billion of free cash flow. And so that kind of roughly works out to about $10 billion of incremental free cash flow from the acquisition. And so Netflix today, combined with the enterprise value of Warner Brothers, is currently trading at roughly a $480 billion market cap. And so basically, if we do believe that they're going to roughly generate $20 billion of quote unquote like 2027 post-acquisition free cash flow, you're buying the business at 24 times forward price to free cash flow, which again, for a business that I think can sustainably generate north of 20% in terms of free cash flow per share growth, if not more than that, probably closer to 25% with a stronger revenue growth rate from the cross-selling. You add a little bit of more margin expansion from the synergies, et cetera, you're probably looking at close to 25% free cash flow per share growth rate. So it's quite literally trading at like a 1 times forward peg ratio, which is just phenomenal. Now, my hesitancy with that last option is that I kind of already have Uber in my portfolio as that sort of like newer tech company, growing pretty fast. And so I'm kind of thinking in the back of my mind, like, okay, if I'm going to open a Netflix position, I might as well just add more to my Uber position that I understand super well, et cetera, et cetera. But nonetheless, I'm not really ruling it out, right? So the two opportunities that I'm kind of looking at are between that and FICO. And again, to get the live news on that, if and when I do kind of go through with that transaction, be sure to track my portfolio live over on Blossom, again, completely for free. And so with that being said, thank you very much for watching. The 2 videos should be up on screen now for the Safran deep dive, and additionally, my take on the Netflix Warner Brothers acquisition from the day that the news broke out. Feel free to leave me comments down below with what you think. Thank you very much for watching, and have a great day.